What is DeFi? Decentralized Finance Animated. DeFi stands for Decentralized Finance. In the past, we have always used centralized finance, where there's a central authority that controls the flow of money. Government and the banks control it. They don't overtly state this, but they indeed do. They can print more money if they wish, prevent you from borrowing if they wish, and even stop you from having a bank account. They could take your money at any time, and because they have your money, they could change it, and you really couldn't argue against it. Moreover, they limit what you can do if you're running a business. For instance, if you have a little magical tree business that may be for medicinal purposes, they can direct you not to bring in any of that money from the business to the bank. This seriously limits you, as you can't deposit it, invest it, or even use them to keep it safe. Welcome to Crypto Codebreaker, your gateway to unraveling the mysteries of cryptocurrency. Don't forget to show your support by liking the video and hitting that subscribe button. Here, we explain topics of the cryptocurrency world using analogies, stories, and examples so that you can easily understand them. The rates are very high, but you have to pay them because that's what you were given. There is also decentralized banking, which doesn't have any banks. There are instead pieces of code that run and work like a bank. Anyone can use them. Since they're just a piece of code running a program, you don't have to trust them. There is a chance that you could read it and make sure it's not a scam. Lastly, they are much cheaper than standard centralized finance and can't be censored. Decentralized finance is built on three main things: cryptography, the blockchain technology, and smart contracts. If you don't know what these are, it is recommended that you check out other videos on these topics. Let's dive into the 5 pillars of decentralized finance. Number 1, stablecoins. These are cryptocurrencies that are matched to a real-world asset. For example, DAI, Tether, and USD coin are all what we call stablecoins. Their price is tied to the United States dollar. When you buy one for $1, a new USD coin is minted. When you withdraw one, a USD coin is burned, so the coin is always worth $1 United States dollar. The purpose of this is to have a reliable way to buy and sell certain coins without having to buy and sell them. We can trade them instead. Here's an example of how this could be useful. Say you paid $500 for an Ethereum. It's now $1,000, and you want to sell it because you think the price is too high. You're ready to take your money. You can only sell your Ethereum at a centralized exchange like Coinbase or Binance if you don't have any stable coins. In trade, they will give you US dollars. Of course, they'll take a cut of that deal because they want a fee, and they will. The IRS also wants you to pay taxes on any profits you make when you trade or sell things. You can't really get around it because Coinbase and Gemini will find out that you did it. Next, you should wait for Coinbase or Binance to send them to your bank. After that, you should take the money out of your bank because you don't want the bank to have control of your money. Well, a month later, Ethereum drops to $250 and you want to buy more. So, you deposit your $1,000 back into Coinbase, wait a few days for the transaction to clear because you have to wait, and then buy 4 Ethereum and hold them. Well, Ethereum rises again to $500 and you decide to sell. So you sell them at your centralized exchange, you bite the fee, and then you wait a few more days for it to hit your bank account. See, in this example, there's a lot of fees, there's taxes, and there's waiting. Now let's say we utilized a stable coin like USDC. You paid $500 for 1 Ethereum, and now it's worth $1,000. You can just trade your Ethereum for $1,000 US and hold on to it, instead of going through all that trouble. After 1 month, it drops to $250, just like in the last example, and you sell your $1,000 US for 4 Ethereum. The price then goes up to $500, and here's the good news. You can sell your 4 Ethereum for $2,000 in 5 minutes. Because you traded on what we'll call a decentralized exchange, the fees were less than 1%. But because of that, you could trade almost right away, and the USDC was safe since it was just code. You trusted it. It doesn't change like Coinbase, Binance, or Gemini, which are run by people and the government. They've been hacked before. Anyways, we are getting off topic, so that's the purpose of stablecoin. You can be in the cryptosphere without actually using your government-owned bank. Now, in a lot of places, we take banks for granted, like in the US, but some countries are really limiting in how much money you can move around or what currency you can buy them from. In fact, in the United States, every transaction over $10,000 has to be vetted and approved by a bank. Meanwhile, using a stable coin like USDC, you can move $10 million from one address to another without anyone blinking an eye for like a $5 fee. You could never do that with United States dollars. Number 2, borrowing and lending. So another important pillar of decentralized finance is lending and borrowing. In fact, a huge part of our current financial situation in the world is based on lending and borrowing money, so it would make sense that the blockchain could do it better. We can trust banks to lend and borrow money because we generally put something down as collateral, like 20%. This way, if we don't pay back the loan in full, the government can come after us and jail us or make us pay that money. In short, not paying back a loan can get you in trouble with the law. In the case of crypto, this is a problem since privacy is one of its benefits. You could only put down 20% and then disappear with the rest of the cash. We need to find a way to make this work. With smart contracts, we can even let other people use our money while still having control of it. So, let me give you an example. Someone wants to make interest on their coins, and someone B wants to borrow some coins. Person A puts his coins into a smart contract on either Compound or Aave, two platforms that let people borrow and give crypto. If you don't already know, smart contracts are just pieces of code that do a certain thing. In turn, what he gets are called C tokens or A tokens that are a representation of his original coin plus interest. Whenever he wants to, he can just turn his A tokens or C tokens into that smart contract that was created by Compound or Aave, and they spit out his original deposit plus interest. Now, the smart contract is created this way so that there's no human being that has to do the calculation or have to do the transaction. It's all automatic, by code. So that solves person A wanting to earn interest by lending. In a traditional way in the borrowing portion, person B must do something called over-collateralize his loan. This means if he wants to borrow $100, he must put up $120. So that way, if he runs away and never pays back his loan, the smart contract is written in a way that it can pay back person A their coins plus interest. Now you may be wondering, why get a loan if you already have the money? Of course you're probably thinking in US dollars. Let's say you have 10 Ethereum that are worth $1,000 because each one is worth $100. You don't want to sell them because you have a lot of faith in the Ethereum project. So you use them as collateral to borrow $800 worth of Tether, a safe coin that is linked to the US dollar. You move that $800 around, making and losing money, and then making more money. Now it's time to repay your loan. You have $850 in Tether. You pay back the original $800 loan to get back your 10 Ethereum. In this little example, you made $50 from the little trades that you did, and you got lucky. It has also been a few months and Ethereum, like it has done in the past few months, exploded, and now they're worth $150 each. So now, you have 10 Ethereum at $150 each, so now you control $1,500 plus the $50 you made trading. Basically, if you believe in Ethereum and have some, but don't want to sell it, but still want to use its value, you can borrow against it with the hope that it will be worth more when you cash it out. Although, if you exchanged, you might have lost some, gained some, and then lost some more, and in the end, you might have ended up with $750 in Tether. Option A is to pay the extra $50 to repay the entire loan, or $800, and get all of your security back. Choice B is to keep your $750 and lose your 10 Ethereum, which is worth a lot right now. This might be information overload, but real quick, there is a second type of loan in crypto called a flash loan, which is a loan that lasts for like 10 seconds. If you could buy Ethereum for $10 on Coinbase and then sell it for $11 on Gemini, theoretically, you can make $1 every time you did that. And so, you can use what we call is a flash loan to literally borrow millions of dollars. You don't have to put any money down. You just write a flash loan to borrow $10 million. You tell it to go buy Ethereum for $10 and then immediately sell it for $11, and then you pay back the original loan, $10 million. and all one small little smart contract that gets run in 10 seconds. The only thing that kept you from making $1 million was the fees you had to pay to borrow the money. These fees are very low though, because the lender knew you would have to pay them back quickly. Even though this is a more complicated method, you would never be able to do this kind of arbitrage in normal business. The third thing is decentralized markets. From the United States, a friend of mine went to London a few years ago. Of course, euros are the standard currency in London, while dollars are the standard currency here in the US. Because of this, he had to go to a booth to swap his dollars for euros. Unfortunately for him, the fee was like 15%. So he immediately lost 15% of his money because that's what foreign exchange traders do. Tourists don't know any better, and they need local money, so what they do is they take advantage of these people. Well, when it comes to decentralized finance, instead of a foreign exchange trader, we have what is called a decentralized exchange, where you can exchange your coins and tokens for other coins and tokens. Now, the fees are usually very small, like less than 0.5%, which is a great benefit for anyone who regularly wants to trade their crypto assets. Most popular decentralized exchanges or DEXs work in a manner where investors pool their money together, and then traders can trade that money. Those investors still get the fee I talked about earlier for every sale. It's all written in code, so it doesn't change. The government should not be able to tell people they can't buy Bitcoin. You can only change the fees and amounts, but they are locked in. They're written in code, which means they can't be changed or made more expensive by 15%. With decentralized platforms, you can buy and sell a huge range of tokens and coins. At the time, you can only buy and sell 32 cryptocurrencies on Coinbase, which was the first centralized exchange to go public. Because the government controls them and makes them follow certain rules, they carefully look over every coin before adding it. The most popular decentralized exchange, which is called Uniswap, literally has hundreds, maybe even thousands of tokens that you can trade, and they aren't regulated by anyone. That's the decentralized part. There are billions of dollars locked up in these liquidity pools, so traders can trade, but nobody can control these billions of dollars. They're just following a program that someone wrote. In fact, only investors can be the ones to pull out their money out of the pool. But if they did that, the lending rates would rise, and so new investors would come along and put their money in. Also, the code can't be changed, as I said before. That's what we mean by immutable. In the world of crypto, we say that the code is the rule. It's not the government that runs it, the code does. The code stays the same and can be used by anyone. Another big exchange on the Ethereum network is Uniswap. It has pools of billions of dollars. There are a few $1 billion in cash on PancakeSwap, which is another trade on the Binance Smart Chain network. Number 4, insurance. Insurance is really easy to explain. For example, with car insurance, you pay $100 a month to protect your new Tesla. However, one day while using the autopilot feature, another car causes the autopilot to glitch and you drive into a ditch. Unharmed though, but you totally wrecked the car. Well, since you paid insurance, the insurance company pays you what the Tesla was worth so that you can go buy a new one. They use statistics to predict how many of their drivers will crash their cars, and then use this data to predict how much they would have to pay each year to determine what the monthly price of the insurance should be, which is also called the premium. Yes, the insurance company can be coded with autonomous finance. Now, let's look at an example. Let's say a farmer wants to get crop insurance. He planted his crops knowing they might die, so he will still get paid for taking that chance. We could add code to the Ethereum network that says Farmer Joe should get $100,000 if it gets 90 degrees Fahrenheit or higher 4 days in a row this summer. Nevertheless, he needs to pay $2,000 to begin this agreement. For example, Farmer Joe can buy crop insurance through a smart contract, which is just code that checks to see if the conditions are met so that he gets paid. So at this point in time, you might have two questions. How does the code know if it's 95 degrees Fahrenheit? And where does $100,000 come from? Well, to connect the real world to the blockchain, we have to use something called oracles, which are trusted sources that become a bridge between the real world and the crypto world. We can create an oracle in our city that reads the temperature and is verified by a few people to make sure that it can't be frauded. Then the smart contract can reliably use it as a data source to decide if insurance requirements are met or not. Secondly, the $100,000 comes from other people buying insurance that bought the premiums, but maybe they didn't get paid out because the requirements were not met. Insurance companies make money by charging premiums. People who lend money to a decentralized finance platform may be offered an interest rate to encourage them to do so. For example, some of the $100,000 may come from buyers who lend their money and make money. And finally, number 5 is margin buying. That being said, margin buying is a whole new animal. Let me quickly talk about margin trade in the real world, and then I'll talk about it in the decentralized world. So, you want to buy the Apple stock and right now, it is $100. So essentially what margin is it is a loan that will automatically sell your stock if the stock goes below your down payment. So to buy a $100 stock, you need a $100 loan. And the bank agrees to give you that $100 loan if you can give them a $20 down payment and a small fee of 5% a year. So here's 2 scenarios that could happen. The stock goes up from $100 to $150. When you have enough cash on hand, you sell the stock and get $150. The bank already had your $20 down payment, so you only have to pay back $80 of your loan. You keep the rest, which is a return of $70. In a sense, you made $70 while only paying $20. That is, even though the stock only went up 50%, you made 3 times as much money. This is what margin can do. You use it to make more money when you think the value of something will go up. Now let's take a look at another situation. This is the second scenario, and it's if the stock drops to 50. Well, with margin, you actually have to sell as soon as the value of what you bought can't pay back your loan. The stock starts out at $100, then it starts dropping to $90, $85, and then as soon as it hits $80, the bank forces you to sell your one stock of Apple at $80. This is done so that you can pay them back the $80 that you borrowed. You paid back the loan with the $20 you gave them as a down payment and the $80 you made from selling the stock. Now, the bank has the $100 they gave you in the first place. Now that you've paid back your loan, you're free and clear. But you didn't get anything out of it. In fact, you lost the $20 you put down as a down payment. In organized finance, you usually need to show proof of who you are in order to trade on margin. Plus, you need at least a few $1,000s to be able to trade on margin. Also, the fees are a lot higher, over 5%. In decentralized finance, margin trading can be a lot quicker. It's open to anyone in the world with money, and it can be a lot safer as well. Welcome to Crypto Codebreaker, your gateway to unraveling the mysteries of cryptocurrency. Don't forget to show your support by liking the video and hitting that subscribe button. Here, we explain topics of the cryptocurrency world using analogies, stories, and examples so that you can easily understand them. Thank you guys so much for watching, and we hope to see you in the next one.